Welcome to this Tuesday, January 23rd, 2024 edition of Trading Places live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be with you here for the next 30 minutes or so as we take a look at what is transpiring in the market, what transpired yesterday, and maybe what we can look forward to throughout the rest of the week. First, I will say futures mixed. We got Dow futures down slightly. We did finish over 38,000 yesterday. New milestone for the Dow. S&P 500 futures up about 9, which is about 0.2%. NASDAQ futures up almost 50, which is a little more than 0.25%. And the IWM is best of all. And let me see if I can get you that number. Right now, we got the IWM up 0.8% this morning. So IWM following through on a really strong day yesterday. It's up $1.59 today, above 198. So it's getting above the most recent reaction high. And we'll be taking a look at that here in just a minute. But let's go ahead and take a look at the action yesterday across the board. We did see the Dow Jones Industrial Average finish up 138 points. As I mentioned, closing above 38,000 for the first time, 38,001.81. Don't forget that 1.81. We did get above that 38,000 level, and that kind of shows it there. S&P 500 up a little more than 10 points. That was up a little bit more than 0.2%. And the NASDAQ 100 rising 16 points, up almost 0.1%. It was kind of interesting, though, because we saw some of those tech names throughout the day kind of drifting lower, and we saw the small caps, financials, and some of the other areas start to make a move. It's been a rough go so far in 2024 for small caps and for some of these other value-oriented stocks. And, you know, financials have an element of growth. I mean, they certainly go along with the economy, and to some extent they can lead. I think this could be a good year for banks. They didn't get off to a great start, but they did have a nice day and have started to pick things up more recently. Mid caps gaining 31 points. That was over 1.1%. And finally, small caps rising more than $4 yesterday. The IWM going from 192.43 to 196.54. Really strong day, up more than 2 percentage points. And as I mentioned, certainly following it up with some strength here this morning, the clear leader in the pre-market action. Transports made a big move yesterday, getting back up near that 16,000 level, rising more than 2.2%. Transport's very strong, kind of moving out of this sideways consolidation period, if you will, that we were in to start 2024. Really strong day on the transports yesterday, led by trucking, and I'll show you that chart in just a second. Industrials, the leader, of course, transportation, a big part of industrials. Industrials, the number one sector yesterday, gaining more than 0.75% and turning up out of what looks like to me maybe to be a break of a bullish wedge. So you can kind of see that long uptrend over the past few months. And then if you connect the highs over this pullback and the lows over this pullback, you have kind of almost like a slice of pie. It's kind of getting a little bit narrow as you get toward the tip of the pie. Anyway, when you break out of that, that's a normal continuation pattern off of an uptrend, and a breakout can signal the start of another big move to the upside. So industrial certainly worth watching after that move yesterday. Financials breaking out to a new high. Love to see this. Financials, big laggard over the past couple years and really over the past decade. I think we're actually in a possible sweet spot here for the financials in 2024. As we see the 10-year Treasury yield pull back some, but I think we're going to see those short-term rates. Fed funds rate, I think the Fed's going to cut a number of times in 2024. And I think what we're going to see is that inverted yield curve now turn more normal. And that is a good thing for banks. Banks tend to struggle with an inverted yield curve. And then, of course, depending on what that means to banks, how bad things get, they can certainly cut off lending and liquidity to the economy. But that so far hasn't really taken place. I mean, we've seen some of the bigger banks like JP Morgan coming out reporting great numbers, even in that not so great environment for banks. And so now I think they're going to get a little bit of tailwinds in 2024, and financials making another breakout. I think that's significant. Real estate, pulling back, but this is another value-oriented area, less aggressive. I would say it's more defensive than financials and industrials, but they're all dividend payers. And I've talked about maybe 2024 being more about them and less about technology as we get into 2024. We'll have to keep watching this. I hate to bet against technology, and I don't think it's going to be a bad year for technology. I just don't know that it's going to be a super, year where they show tremendous leadership, where, technology goes up 40 or 50%, while financials go up 8%. I don't see that kind of a disparity in 2024. I could be wrong. Certainly, we got off to a really good start here in 2024 with technology, but I'm still expecting to see some rotation there. Maybe the last, certainly yesterday, maybe that was the start of something. I don't know. We'll keep an eye on that. Truckers, there they are. Truckers had a huge day yesterday, gaining more than 3.5%, jumping up above all that consolidation that was on that chart to start 2024. Now looking at the 1800 level, the highs we saw in December maybe is the next target. Renewable energy, it's been a really rough period in 2024. Started to strengthen a little bit in the fourth quarter of 2023. Thought, okay, maybe we're getting something going here on the renewable energy. But to start the year was horrible. The group moved right back down. Big drop from over 330 down to about the 260 level in just a couple weeks. 330 to 260, that's more than 20% drop. And we're talking about just the first 2 to 3 weeks of January. They did rally back, though, yesterday, gaining 2.75%. Certainly wouldn't call them healthy, but gaining 2.75 yesterday is better than losing another 2.75. So we'll kind of follow that, see if we can get back up through that 20-day moving average. And then finally, recreational products yesterday also having a strong day, gaining 2.65%. This is in the discretionary area. So the top three industry groups, we had discretionary, we had technology, and we had industrials represented by the various industry groups there. Moving on to the 10-year Treasury yield, let's get a quick update, see where we are. We are up about 3 basis points, 4.13%. I think we're in a little trading range here. I guess maybe more short term, you could even see the squeezing between the 50-day moving average and the 20-day moving average, 50-day moving average dropping, 20-day moving average rising. And so that little in-between area is where we have now seen the 10-year Treasury yield close for the last 6 trading days. Which way does it break? I believe it goes back down, but, I'm open to whichever way. I do think it seems like we're going to be in a more consolidatory, or that's probably not a good word. I think I just made that up. Consolidation phase from 380 up to about 420. But that would require a move back down through the 20-day EMA. So we'll see how that plays out. But right now, the 10-year Treasury yield, short term, very short term, trending higher. More intermediate term, still in this downtrend. And then I'd say long term, looking back over the last year, we're almost where we were 1 year ago. Maybe up, I guess, from 1 year ago, but maybe 11 months ago, certainly. And then probably again about 6-7 months ago, right at about the 410, 420 area. So we've done a lot of ups and downs, but we're really right back where we've been a couple times over the past year. So I would say it's a little bit more sideways action from a longer term perspective. Let me take a look at the economic calendar, because I really didn't look. I don't think we had anything today. We don't. Nothing of significance. Of course, we've got the 4-week bill, 8-week bill, 4-month bill, 52-week bill, 2-year note auction. We got all that, but I'm talking about the key economic reports, and there's not really anything coming out this morning. Tomorrow, we'll get one report. It's the PMI composite flash. And then things will pick up on Thursday. We got the first reading of GDP coming up on Thursday morning at 8:30 a.m. And that, of course, is for the fourth quarter. Let me see what the estimate is there. Because, of course, we had some pretty big GDP readings in 2023. We're expecting it to slow. I know at one point there were a lot of economists looking for about 1.5%. I see the consensus estimate right now, quarter over quarter, is 2.0%. So looking back at Q3, that was 4.9%. That was the final reading of quarter 3 GDP. And so we're dropping down to 2.0. And that's what most economists are expecting in 2024. Growth, but lower growth. And that combined with rates coming down, said it many, many times, it's nirvana. I think that's one of the reasons why we saw such a big rise, one of the biggest since 1950 on the S&P 500. That November and December and even January run broke back out now in January to all-time highs on the S&P 500. Market looks ahead. I mean, that's what happens. When we saw the 2022 cyclical bear market, the market was looking ahead. Interest rates didn't start rising appreciably until May? I think May 2022 was the first 50 basis point rise. Market had almost hit its bottom. The June low was essentially the bottom. We went down a few more days in October just below that low, but essentially the low went in June of 2022. And the rates were just getting started to go higher. So one thing I think we've got to be careful of is I think the market is has been pricing in this series of interest rate cuts and a strong economy. So that's why I believe maybe the second half of the first quarter, we could see one more move to the downside. And then I think as we get a better glimpse at the economy going forward, if it's going to remain positive and rates are going to come down lower, that's generally a pretty good thing for the economy. And I think a lot of that's been built in to areas like technology, but I don't think it's been built into areas like financials. And so that's one of the reasons why I think we'll see maybe a little bit more movement toward the financials in 2024. We'll follow the market throughout the year and we'll see what happens. But that is one of the things I'm looking for. So anyway, GDP expected to come in around 2% on Thursday. We'll see what happens there. We've also got durable goods orders, of course, initial jobless claims on Thursday. Friday, we got personal income and spending coming out, also pending home sales. So still got a number of reports, economic reports coming out. And of course, every day now for probably the next month, or maybe at least the next 3 weeks, we're going to see more and more and more and more companies reporting their earnings. Things are really going to begin to accelerate later this week, and especially into next week when we start getting some big ones like Apple and Microsoft and so forth. So things are going to be picking up there. We'll be here to go over it with you, take a look at some of these earnings, see what kind of reactions we're getting. That's what we do at EarningsBeats. Okay, moving on, S&P 500. So here we are. We broke out since our last show. We did make that big breakout above 4,800. The bulls didn't really leave it in doubt there. You can see a really solid hollow candle. You can also see the volume being the highest of 2024. Yesterday, we followed up a bit, although we didn't really move much from the open to the close. We did gap up, move higher intraday, pull back, still finish with a gain of another 10 points or so, finishing at 48.50. But the last 2 days, yesterday and of course Friday, was option expiration. So we do tend to see a little bit more volume with that. So it's really hard to say that that was created because of the breakout. Could simply just be because it was option expiration day. And that's when we see a lot of volume as traders move options from 1 month to the next month, and a lot of trading of the S&P 500 and some of the individual components, stocks, sectors, and whatever, as we closed out that option expiration period. So we'll keep looking at it, but hey, yesterday volume was really strong, solid again as we moved up higher. These are all good signs for the S&P 500. I also love where we've seen strength. I mean, if we go into the dashboard and you can go over to the sector summary and then hit year to date. And when you look at year to date, what's on top? Technology, communication services, healthcare, financials, there's industrials, and there's consumer discretionary. The 5 aggressive groups. Parts of healthcare are aggressive as well, but also parts are defensive. So it's kind of a hybrid. But if we throw healthcare in there, 6 of the top 7 groups that I like to see lead the market are in the top 7. I mean, of the top 7, 6 of them are the areas that I like to see lead the market. And that's what's leading here in 2024. This is not a shift to defensive groups. This is not a, let me go buy utilities and consumer staples and let's, hunker down here for the big recession ahead. That's not how 2024 is opened. I mean, you can get on the bearish side if you want, stay on the bearish side. Some have, But the market's not telling us that. The market is not telling us to be bearish, to be conservative, to be, to hunker down because of the rough times ahead. The market's saying it's full speed ahead, which is what it said all during 2023. Nothing really has changed. NASDAQ 100 did get a little bit of reversal yesterday. I mean, if we had come down and put a big bearish engulfing candle, something like that yesterday, I probably would be a little bit more concerned. I mean, that's finishing on the low is not as good as finishing on the high. But I mean, we've seen this before. I mean, we saw this right here back in the middle of November. We had a big rally, had that little bit of a black candle there, closing down closer to the low. Really didn't trigger any major selling. We did go sideways for a while, hit the 20-day, and then went back up again. As you look at this, there is a negative divergence in play. Not going to argue that one. Short term, the market could pull back. I would feel worse about this negative divergence if we get a solid reversing candle. A gap up, selling all day, heavy volume, close below the prior day's close, even below maybe Friday's close. Really a big red filled candle to the downside. I think that would be a significant development technically with a negative divergence. But I'm not seeing that just yet. Yesterday's candle, not the best. It is, a thin black candle, and sometimes black candles, especially if you have a really big gap up and then you sell off and you still finish up for the day, but you have a really big black candle with heavy volume. It means there's a lot of selling throughout the day after that early morning gap up. This, I'm going to say, is probably not the reversing candle that I would be looking for. But let's see how things transpire. If we start to put in lower lows, lower highs, that also can reverse a short-term move to the upside. So I'm not ignoring this negative divergence. In fact, I've been talking about it to our members at EarningsBeats quite a bit, and it's keeping me on my toes from a bullish perspective, because again, negative divergence doesn't mean you're going to go lower. But if you start getting corroborating signs like reversing candles, the odds increase. Again, that doesn't guarantee anything either. Nothing guarantees us anything. I use technical analysis to evaluate risk in the market. That's what I use it for. That's all you can use it for. Those who don't follow technical analysis a lot of times will say, see, this didn't work. This is a reversing candle and we didn't reverse. Or look, we broke the trend line and then we came right back up above the trend line. See, technical analysis doesn't work. That's all hogwash. Technical analysis, for those people, they're using it wrong. They're looking for a guarantee. You're never going to find a guarantee from technical analysis. Not ever. Not that I'm aware of. If you know any guarantees that you've seen in the stock market, I'd love to know what they are. Please post them in our, question and answer or chat box. I would love to know if you found something that is a guarantee, because I've been doing this for a long time and I've never found anything. But when you start getting a lot of signals, a lot of corroborating signals that are pointing in one direction versus the other, the odds increase. And it may be that you're on the wrong side of the trade based on what those signals are saying. That means your risks are increasing. That's what technical analysis tells me. And when my risks get really high, like we saw at the beginning of 2022, I'm not going to go back over all that, but there were all kinds of signals saying 2023 was, or 2022, it's actually at the end of 2021. The signals were saying 2022 was likely to get off to a rough start. And then you simply just got to follow the price action. When you start seeing the price action confirm what you typically see in a bear market, you have to be prepared to act. You don't want to hold during those periods. I see nothing like that right now. Nada. Not one. Well, I see a couple things that, you always worry about in the short term, but I don't see any long-term problems in this market right now. Just my opinion. We'll see what happens. Russell 2000, love the move yesterday. We've now got 3 days in a row of higher highs and higher lows, and we're starting to see outperformance again relative to the NASDAQ 100, relative to the S&P 500. And what's really interesting is when you look at the IWM relative to the QQQ. You ready for this? Man, that looks bad, doesn't it? Russell 2000 getting back down near the November low. This just looks awful, right? Let me show you a chart that I keep I use a user-defined index. And this is the user-defined index that I use for the IWM. So this right here is the IWM QQQ that we were just looking at. That is what we were looking at, straight down. It's a line chart. I had candlestick chart up, but basically it's been straight down. And what this looks like on the surface is that money is rotating horribly away from small caps and into large caps. That's what it looks like, and that's what most people see. I keep a user-defined index and I ignore gaps, because gaps, in my opinion, are the biggest single piece or single biggest manipulative tool that market makers have. They can kind of guide us by the nose, telling us where the market's going to open, where it's going to, where, if it's going to open higher, if it's going to open lower. And it can kind of, in a emotional way, coerce us into buying or selling. 2022 bear market was a perfect example. We kept seeing gap downs. First 3 months of the year, pure distribution. I got no arguments. You look at those candles, they're all red filled candles and prices are going down. Everybody's selling. No manipulation whatsoever. But when you started to get to April, May, and June, you could see that we were gapping down. No big red candles, or fewer big red candles. We were starting to lose a lot of ground by gap downs. And then we were recovering magically during the day. Still finishing down for the day, so it still looked ugly. But during the intraday, the signals were much different than what we were seeing at the opening bell and in the first 30 to 60 minutes of trading. Amateur hour is what I call it. Because market kept gapping down. We had all this bad news out there, and retail traders were just taking the hook and the bait and trying to run with it, selling everything at the opening the opening bell. And then we would see morning weakness, and then market makers, Wall Street, would magically appear and start buying everything they could in the afternoon. And I kept saying back in June, when I called the bottom last year, I said, hey, I could be wrong, but it certainly does look like a lot of accumulation to me by Wall Street. And then we know what happened after that. How far has the QQQ gone up? Who made the most money? I can promise you it was the Wall Street firms. They weren't going on CNBC telling you how much QQQ they were buying, but you could see it on the charts. Well, here I'm looking at the IWM relative to the QQQ. And on the surface, here we go. Hey, we're going straight down. This looks horrible. Why would you want to own small caps? QQQ's been killing it over the last 3-4 weeks. Well, if you look at the intraday action, I'm looking at a completely different picture. We're not seeing a big move to the downside like this. If we only look at what happens from 9:30 in the morning from the opening bell, that's where we start, the opening price, and look at what happens during the day. This is the chart of the IWM QQQ. Looks a little different, doesn't it? And look at the QQQ versus the spider down here, including gaps. The QQQ is breaking out. Looks like it's killing the spider. Look what's happening over the last month and a half. Actually, almost 2 months now. During the day, there's rotation, folks. Money is rotating out of the QQQ and more towards spider, which they hold some of the same stocks, but the spider doesn't hold as much of those big technology names. And they have more of the value-oriented industrials, financials, and some other areas. And so what I'm seeing is during the trading day, money rotating away from technology and into the spider, into small caps. And that's why I think those areas are likely, not guarantee. I cannot provide guarantees. This may turn out to not really give us any signal at all. We'll see. But I believe it's a significant clue that alerts me to the fact that there's a really good chance that the S&P 500 outperforms the NASDAQ this year, and that the small caps might soar. We'll see. Again, it's just signals I'm getting. I call it like I see it. Try to explain my reasoning, and then you can agree with me, disagree with me. It's up to you. So let's go. This was checking out the IWM earlier. Let's see where we are right now. 198.40, almost up 1% on the IWM this morning. Let's look at the others. QQQ up 0.12. Now we're starting to see a little bit more shift over toward the small caps. Spider up about 0.1%. Diamonds down a little bit. So look, again, IWM up almost 1%. So we're starting to see some of that shift. And I'll be watching during the trading day, because that to me is really important too. It's not just gap ups. During an up, once the QQQ in 2022 bottomed and we started moving up throughout 2023, you'll see that the QQQ gapped up and we moved higher. Gap ups aren't necessarily a bad thing. I mean, once Wall Street's got their shares, do you think they're going to wait around and let all of us get our shares? Once they're ready to go, you can start seeing gap ups. And after a while, we bet against it because we're still thinking bearishly during 2022 because of the bear market. It takes us a while to get our brains around the fact that, hey, the stock market's really going up a lot and we're not really making any money, probably losing because we're either not trusting the rally or we're still shorting. You got to get ahead of that curve or you're going to get killed in the market. And I spent 40 years now trying to figure out how to get ahead of that curve. And it's not perfect, but I think a lot of our signals work pretty darn well. So we'll see what happens. But once Wall Street's accumulated, there's no reason for gap downs anymore. They're not trying to accumulate. They don't need to scare you anymore. They got their fill. And then you start seeing gap ups. Everything all of a sudden seems fine. What happened about all those issues? Wait a minute. I don't understand. Then you start seeing the good news the next year. I mean, if you're still looking at 2023, wondering how the stock market went up, I just ask you to go back and look at technology earnings. Do you know that NVIDIA was earning a year, back in 2022, NVIDIA was earning like 50 or 60 cents a share. And by the end of 2023, it was earning over $4 a share per quarter. Do you not think that NVIDIA deserves a higher price and a higher multiple, like way higher? This is supported by fundamentals. I mean, we're still in a very low interest rate environment. Look at history. 10-year Treasury yield near 4%. Are you kidding me? I'll take that anytime. But everybody's so focused. Oh my gosh, it's gone up so fast, 1 to 4%. 1 to 4% isn't going to change someone's mind that needs to borrow. Still a very, very low rate. Anyhow, chart of the day. So let's take a look at the first our website over at EarningsBeats.com. I invite all of you, if you haven't already taken us up on our free EarningsBeats Digest newsletter. I don't know why not. It's free. I'm providing a lot of what I think is valuable information. I mean, some of what I talked about earlier with the rotation. I mean, things like that occasionally I write about in the EB Digest. It's not always about, oh, Apple looks good, Apple doesn't look so good. It's not that kind of a newsletter. I try to put a lot of educational content in there. I'll talk about sentiment issues. There's a lot of things that we'll go over. Look at the overall market, sometimes big picture, sometimes what's happening in the near term, maybe just what happened over the last 3 days. Individual stocks, could be trading opportunities. Try to make it valuable. Anyway, it's delivered Monday, Wednesday, and Friday to your email box. Name and email is all it takes. There's no credit card required. You don't have to stick with us if it's not something you enjoy or you like, or is not really providing value for you. Unsubscribe. No questions asked. It's very easy. You hit the unsubscribe button and you're done. But check that out if you haven't already. Again, we have tens of thousands of people that have signed up for our EarningsBeats Digest. So this isn't any joke. This is a nice newsletter, and we try to give back to our community. I know that there's a lot of folks out there, younger folks. Maybe some of you have kids, grandkids that are just starting to get, maybe just getting their first job, getting out of college. They need to start learning this stuff early. It'll make a massive difference. I wish I knew this when I was in my 20s. I wish I knew the things I know now. I wish I knew it back in my 20s. And also, when I was in my 20s, if I wanted to buy a stock, I had to pay a commission of $150. I mean, it just wasn't set up to get in and out of areas and to rotate and things like that. It was almost impossible. It was too costly. Completely different environment here. It's so much easier to get started in the market. But anyway, check that out. If you haven't already, please subscribe. We'd love to have you as part of our community. We do free events from time to time, by the way, at EarningsBeats, and we will reach out to anyone that's on our free newsletter. for those free events. So check it out. And if you really want to support us, one way is to sign up for a 30-day no-cost trial. You do have to give a credit card, but you'll be with us. You'll see everything that we do and that we offer for 30 days. And from there, you can decide. We'll remind you when your 30 days is up. We don't want you to be a paying subscriber if you don't feel like the service is worth it. Anyhow, check all of that out. We'd love to have you. And if you don't want to do any of that, hit the like button and subscribe to our channel. That would help us as well. So those are some of the things you certainly can do to help us at EarningsBeats. So the chart for today, and the market just opened, so let's make this real quick. S&P 500 up here making this breakout. What I did below is I showed the IWM, because the IWM, you can see the S&P went sideways, NASDAQ went up. IWM went down for the last 2 weeks. That's what I was talking about. If you just look on the surface, if you don't do any studying, any research, and you just look at it, you're going to say, my gosh, small caps, here we go again to the downside. But the under the surface signals aren't exactly saying that. So I want to just put that on the chart. Here are the 5 key sectors relative to the S&P 500. Technology leading. Now that might look a little different if we did an intraday. I don't follow the XLK relative to the S&P on an intraday basis, but I suspect that this would not be a straight up line like this right now. I suspect if we were only looking at intraday, it would probably be flat and maybe even starting to roll over. I don't know because I don't have that information, but I'm just guessing. XLY, not been a very good performer, and I can tell you one particular reason why. Tesla has not been doing well. Tesla goes through periods, up periods and down periods. This has definitely been a down period. It's heading into earnings. It's going to be a really interesting report. Tesla is going to be one of those reports. I think they come out tomorrow after the bell. I think Netflix is tonight. Tesla's tomorrow, but double check me on that. Anyway, that's going to be a big part of what happens to the XLY. Tesla along with Amazon. That's about a 45%, something like that, of the entire ETF. So those two companies, of course, they're huge companies. They're massive companies, employ a lot of people around the globe. So they're, but that size is represented strongly in the XLY. XLC still continuing to move up. These are the two groups that went down here to start the year. And again, I don't have the intraday relationship. This is the close, including gaps and everything. I suspect the intraday on both these groups looks a lot better than this chart right here. But anyway, it's been going down, started to turn back up again. I would not be surprised to see this beginning of more strength in industrials and financials. All right. I'll give you the RRG. I did this right before the show began, just to show you where we're sitting right now on all of the sectors relative to the S&P 500. And if we take this, you can see, and drag this through time, you can see what all of the various groups are doing, all the sectors are doing as we go through this uptrend. And I want you to look first right here, financials. Let me pull the financials up. See the financials turning into the leading category? This was back in October, November. You can see technology, a really strong group on an RRG chart, usually shows leading, weakening, back to leading, back to weakening. You normally don't see it go too far over on the left side of the picture because this horizontal axis is the relative strength. And during uptrends, during bull markets, technology tends to be at the top of the leadership or among the leaders. And so we tend to see XLK, and I can go back quite a bit, but watch XLK's even now off the chart. Let me see if we fit it there. So, I mean, you can see how it goes down into weakening, right back up into strengthening. And now it's rolling back down toward weakening. If it gets down in here somewhere, probably is going to make sense to maybe buy, trade. I like to trade strong groups when they're down in the weakening quadrant. You've got financials here. Let's take a look at the financials, see how they've been rotating during this rally. And you can see nice strength, still solid, not bad action at all on a relative basis, even though we did see that recent downturn on the chart I was just showing you with the 5 industry groups. How about discretionary? Discretionary during this uptrend really has not been the group that's been leading. We can see it starting to strengthen, moving up into that improving area, and then just kind of pausing there. We haven't seen this move over. Maybe Tesla comes out with a better report than folks are expecting, and maybe that gets this group jump started. But right now, that's an area that has been struggling. Communication services, and it's pretty cool where you can just kind of watch and see what these groups have been doing. Communication services, just like technology, hanging out over on this right side of the chart, showing strong relative strength. When you're above, or if you're looking on a vertical, this is momentum. So if you get up into this leading quadrant right here, you've got strong momentum and you've got strong relative strength. Here, you can be moving. You can start having strong momentum in the short term, but it may not ever mean you're going to show relative strength. You can be a really bad group, and then all of a sudden you get a dead cat bounce. And when you get that dead cat bounce, you start to show momentum, but you don't start moving over here until you start showing relative strength over a period of time. So that's the beauty of the RRG. I think this is absolutely brilliant. My good buddy Julius de Kempenaar founded the RRG charts and came up with this idea. You know, I follow a lot of relative strength, but this is one I think that's one of the best ones in terms of visualization. To be able to take the price action and then follow what you're looking at over here. You could do this with a sector or an industry group and put 10 of the leading stocks in that industry group. And as the price of the market's going up, see what they're doing relative to their peers and to their industry group. I mean, it's a fascinating way of looking at the market. So anyhow, I just like to pull this up once in a while. Make sure you know that it's there. If you go to your dashboard and you go over here in the member tools, just scroll down until you see RRG charts right there. You bring it up, and you can there's even groups in here that's already set up, XLC members. So here you've got all of the key stocks in the communication services group. So again, what are they doing as the market goes up? Pick one of them. Here they are down here. If you just click on one of these, it'll be highlighted in that chart above. Okay, let's do Walt Disney. So Disney, you can see just living over on the left side of the chart, improving, couldn't quite get the leading, or maybe just barely, and now it's turning back down. Question for me on Disney is, does it turn right back around and shoot out to the right here? Or is this starting to head back down into the lagging area? So Disney looks kind of interesting here relative to its peers because it is in the leading group, but this is one that you want to have a tight leash on, because if it starts to fall back, you want to be really careful. Let's see what else has been leading here. Meta has been on fire. Let's see what Meta's been doing. Look at Meta on the right side of this chart. Trying to get to see Meta. Okay, there we go. So now watch Meta. Over the summer last year, into July, now we're going into the correction. Into the correction, Meta is in weakening. Look at it start to turn up at the bottom. It never even went lagging. I mean, Meta has been such a strong stock. And then when the rally began, check Meta out. Still moving now back into, remember, this has been a strong group. So Meta being over here on the right side of the chart is still your relative strength. And after having really strong momentum, it's come back down, and it appears to me maybe to be poised to go higher. Or is this the pause I was talking about with technology? You know, the fact that the market's moved back up and Meta isn't going back really significantly into the leading group, is that telling us that maybe Meta is starting to lose some of its relative strength and some of its momentum? I mean, again, here's momentum. I mean, we're sitting right on the middle in momentum and not too far from the middle in relative strength. I don't know. You can look at this a number of different ways. But anyway, I find it fascinating. All right, we're 9 minutes in to the market. Let's go take a look at see what's going on in the market. So the Dow down 89, S&P up 5, NASDAQ up 26. Small cap still hanging on a percentage basis, up 0.75%. Back above 1,300 on the S&P 600 small cap. Let's take a look at IWM. I was watching what I've been telling a lot of folks. I was kind of speculating when we were way down here, and I think when we printed that red hollow candle, I speculated on whether this might be some sort of a cup, or whether this could be a left shoulder, neckline, head. Maybe we would go back up here and maybe fail around 197.5 or so. put in the right side of a neckline. I mean, we could fail from here. Maybe it's just an upsloping neckline, which would not be a bad thing. And perhaps we pull back to the 20-day. That could be one possibility before taking off again. Or, maybe this is now 1, 2, 3. This could be the 4th day in a row of higher highs and higher lows. Who knows? Maybe this just goes straight up to the 205 level. We've seen it before in this group. When it goes, you can see it goes fast. Seems like we're kind of on one of those runs. I don't know which run it is, but I can tell you that I think the IWM is definitely an area of the market that I would have a position in. Personally, I do. How much you weight it is completely up to you. And I'm not a registered investment advisor, so certainly is no pressure, no recommendation here, but you do want to be at least thinking about small caps because they've been underperforming for so long. Usually things, we start making a move back, when something gets too skewed in one direction or the other. So just be careful. I think, IWM could show some leadership. Anyhow, that's it for me. I really appreciate everybody tuning in. I'll be back tomorrow at 9 a.m. for your next Trading Places Live. And don't forget tomorrow also live trading room at 10 a.m. Anyone signing up for the 30-day trial right now to our service will get the next 5 weekly live trading rooms at 10 a.m. That in itself is certainly worth the price of admission, which is $0. 30 days, no cost. Check us out. Anyway, have a great day, everybody. Happy trading.